video 5 minutes ago, but I thought it will be very beneficial for everybody just to know a little bit more about the type of loans.
Sure.
And I specifically wanted to focus on the main three.
Okay.
So if you can just like go ahead and share, as we go, I will ask you questions that might like pop up, and then let's go.
I got you. So there's three main types of loans. There's conventional, which make up probably the majority of loans, and then there's FHA and there's VA loans.
Okay.
There is a fourth. I mean, it's USDA, but it's used very rarely because it's a rural type loan, and a lot of areas just don't qualify. But the main three are conventional, VA, and FHA. The VA and the FHA are considered what they call government loans, and the reason they're government loans is because the government kind of insures those loans. So basically, if people were to default, the government would insure, like the lender, right, that did that loan would get repaid.
Okay.
Okay, they would be made whole if the person was to default on those. Conventional, the government doesn't back them. They're just done privately, through different methods, different lenders. The conventional loans, the main reason why people would go conventional, on a loan, would be they do require at least 5% down, okay, for a purchase, okay. Their interest rates are a little higher than the other two types, but there are certain benefits, to conventional. One is with a conventional loan, a lot of people don't have that 20% down payment, right? So, it's a 5% down payment. And then whenever you put less than 20% down, for a conventional loan, you have to pay what's called private mortgage insurance, which is added on to your monthly payment, in addition to like your taxes, your insurance, those things. But the great thing about conventional is that once you get to where you have 20% equity in the home, you can call your mortgage servicer and you can be like, hey, I think I've got 20% equity in my home now. I'd like to have my mortgage insurance taken off. And so they'll usually run like an electronic appraisal, see if it's valid or not. And then if it's true, they'll remove that monthly insurance payment, which is really nice. I mean, it could be a lot of money. I mean, I've seen it where, someone takes out a $300,000 or $400,000 conventional loan, that private mortgage payment could be $250 a month. So it's a big chunk of money that you can get removed, and you can do it without having to do a refinance, which is really nice.
But the person has to be proactive on calling you guys to get it off. If not,
it'll be the servicer. Yeah, it'll be their servicer. Whoever is servicing their mortgage, they'll call them and they'll verify, that's happening that way. And it's just nice because it's convenient because you don't have to, pay for, refinance. You can just do it automatically that way. And conventional loans, they have a little easier guidelines than FHA and VA does. And one other nice thing about it, especially in the real estate business, is that one of your big concerns always is, will the house appraise, right? Great, whether you're on the buy side or the sell side, that appraisal is always key to a lot of things. The one nice thing about conventional loans is the appraisals tend to be a little more lenient on those types of loans. Not dramatically, but the difference is that like when you order an appraisal, you're going to order a conventional appraisal or an FHA appraisal or a VA appraisal, and the reason is that there's different questions and different things that the appraiser can look for. Like maybe on a conventional appraisal, they'll be able to put in like, hey, do they have granite countertops, versus laminate countertops, right? Because obviously that's a big difference. It might be $5,000-$10,000, worth of granite in the kitchen or in the bathrooms, whereas maybe a VA appraiser doesn't have that capability. So that changes things as well. So I mean, there's a lot of reasons why people might want to go conventional, versus the other two. So that's one of the main things. Is the appraisal is a little more lenient, the ability to not pay the private mortgage insurance when the time comes, and the underwriting is a little more lenient too. When it comes to like certain things that happen during the loan process.
And as far as like how soon they can close on that, is it faster than the other two?
No, they're all pretty much the same.
Pretty much the same.
Generally we can close. I mean, I've closed loans as fast as 15 days sometimes, depending. But I mean, most are 30. I mean, the average contract is probably going to be 30 days from the time you go under contract, and all those loans are pretty much the same, for that. FHA is a super popular, loan, especially right now. Interest rates are much lower on an FHA loan. They tend to be probably about almost a full point lower, which people would say, well, why wouldn't I always just go FHA, right? I mean, if I'm going to get a full point lower interest rate, then I'd be stupid, to go conventional, right? Well, FHA loans, they do allow for a smaller down payment, so it's only 3.5% down, versus 5%. Interest rates are better, but here's the thing: nothing's for free in this world, and so there is a reason why. And so this is what happens. So for FHA loans, there is an upfront, what they call mortgage insurance premium, okay? And so what that is that if you go FHA, and a lot of people don't know this, and a lot of people don't even get told this, even when they buy their first home FHA. I'm shocked at how many people never realize they paid this. But what it is it's a 1.75% charge, okay, of the loan amount that you took out. And I think the reason why people don't realize they're paying it is because it's not something that they're paying like out of their pocket, okay?
It's just added.
It's added to the loan, okay? And a lot of people don't realize that. So for instance, like if you were taking out a $300,000, let's say you're buying a home for $300,000, right? And let's say you were doing a 3.5% down payment, that's roughly 10 grand, right? So that means your loan amount would be like 290. And so you would think, okay, my loan amount is 290. But with an FHA, what happens is that they add that extra 1.75%. So now it's like, instead of being 290, your actual loan amount now is like 296 or 297. So, and a lot of people never get told that, and they never find that out. But that's one of the trade-offs. Conventional, you don't get that upfront hit, like you do for FHA. And the other thing too is FHA has a very set mortgage insurance. It doesn't matter whether you put 3.5% down, you could put 50% down, you're paying the same number. It's 0.55% of the loan amount every month. So again, if you were taking out a $300,000 loan, you're roughly paying, let's say, $150 a month for that that mortgage insurance, right? That never goes away, okay, unless there's one way you can do it on FHA. If you put more than 10% down when you first, buy your home, you only pay that mortgage insurance for the first 10 years, and then it falls off, okay? But if you don't put 10% down, which most people don't, most people put 3.5%, whatever it might be for FHA, that number never comes off. You could be in that home for 20 years, have 60% equity in the home, and if you never change your FHA loan, you're always paying that number. And so what a lot of people do with FHA loans is, let's say they're in the home for a little while, 7-8 years, and now they've got like 20-30% equity in the home, right? Well, a lot of people will refinance that FHA loan into a conventional loan, is what they'll do. And what'll happen then is once they do that mortgage payment drops off, that mortgage insurance payment will drop off. And so a lot of people, if they do an FHA on their original purchase, if they're still in the home for a while, a lot of times they'll just refinance into a conventional, get rid of that mortgage payment or that mortgage insurance payment, and that's kind of what they typically do. But FHA is a wonderful loan for your first home because you can put so little down, 3.5% down. That first hit doesn't come out of your pocket, which is nice. I mean, it does get added to the loan, but I mean, interest rates on FHA, I mean, like right now, interest rates for somebody who probably has like let's say a credit score over, 680, 690, I mean, they're going to be like in the low fives. I mean, the interest rates on FHA loan are amazing. They're really good.
I love that.
And then VA is...
Before
yeah, go ahead.
you hop on
Sorry,
that.
I know it's a lot of
No,
information.
it's okay. I love it. I lost it. I lost the question. Okay, so as far as that, see, if somebody comes to you, how can you decide on what type of loan that person will be doing?
Right.
Maybe if it's self-employee or the amount of cash or the credit, or how can you help them navigate on like what type of loan?
Sure. credit scores are a big piece.
Okay.
Conventional loans, they really hurt you on the interest rate if your credit scores are not like stellar. Like, just to be honest, you know, I mean, if you don't have at least like a 750 credit score, 99% of the time FHA is going to be a much better loan for you, just because conventional loans, just the way they're kind of structured right now and the way the interest rates are, they're not beneficial for people who have less than stellar credit. They hit you very hard on the interest rate, and they also hit you very hard on that mortgage insurance premium we talked about, because that mortgage insurance premium that you pay on conventional each month, that is also based on credit scores. So if you have like a lower credit score, let's say like in the, you know, I don't want to say low, but let's say it's in the 600s, right? That mortgage insurance premium is going to be much higher per month versus someone who had a credit score of like 750. And so what ends up happening is really, it's based on generally how much money you have for your down payment, because FHA you can go a little lower. It's based on your credit scores, you know, and the biggest thing for people generally is like, how can you make my payment the lowest it can be? And that's really what we look at. You know, we say, okay, you know, based on all these different parameters, you know, if you went conventional, this is what your payment would look like. You know, if you went, you know, FHA, this is what your payment would look like. And if it's lower to go FHA, most people are generally going to go, you know, FHA. And the other thing too is the average person only stays in their home for 5 to 7 years. You know, people sometimes get very hung up on these things, you know, like, oh, I'm so worried about, you know, the rates or this or that or what type of loan it is. And it's like, honestly, you're not going to be there for 30 years. Very few people live in the same home for 30 years. You know, it's like most people generally move in 5 to 7 years. You know, it's just the average. So you don't have to get too hung up on it. But working with someone that can do that for you. You know, I kind of think of myself sometimes more of as an advisor than just a broker. Yeah. You know, because just like what you're saying, you know, how do we determine what loan fits you the best? That's an important piece, you know, for that.
I wanted to ask, so let's say that I have the money for the down payment, regardless if of each loan. Do I need to show proof for 6 or 12 months that I have the funds in my account to be able to sustain this transaction? Because that was one of
like reserves, you mean? Like
reserves, yeah.
Most loans aren't looking for. You don't have to worry too much about the reserves.
Okay.
A lot of loans that I do, people like pretty much will move their accounts down to not a whole lot, you know, to make the purchase. I'm not recommending that.
Yeah.
I mean, you always want to have money, you know, because owning is different than renting. But yeah, it generally. You generally don't have to show a ton of reserves, but there is something that is called seasoning, okay, on money. And the reason I say that is I've done business with people, and sometimes they don't understand what that is. Like, let's say you have the funds to make a home purchase, right? And you'd be surprised, but there are people who don't necessarily trust the banking system, okay? Yeah. And there are people that literally will have $20,000 or $30,000 in cash sitting in a safe, or under their mattress. And I'm telling you, I've seen it. You know, I've seen it. Yes. And they're like, oh, I've got the money. You know, I've got, you know, $30,000. You know, and then when they send me their bank statements, I'm like, well, the bank statement only shows me like $2,000. You know, where's the money? And they're like, oh, I've got it in a safe in my house. And I'm like, oh, you know, and what people have to understand is that, you know, when you apply for a loan, they're going to want to see 2 months of bank statements, okay? And they need to see the money that you're using, okay, for the transaction in those bank statements, you know, for the last 2 months, okay? Or if you're getting it from somewhere else, like a gift from a parent, you know, or if you're pulling it out of your 401k or whatever, they have to always track where the money came from, you know. But if that money is already sitting in your account for at least 2 months and it's showing on your bank statement, it's what they call seasoned. It's in there. They don't have to worry about tracing where the money came from. But there have been, many situations where, people are like, oh yeah, I've got it in cash. And if that's the case, then you've got to get it in your bank account
for 2 months.
For at least 2 months, right? And let it sit there, for those 2 months.
Okay.
Definitely.
Okay. Well, let's help in the last one, that is the VA loan.
VA, and honestly, VA is the best one out there. I mean, and the reason it is because obviously our veterans, so important, and the U.S. government wants to give them a great option and reward them for their service, and VA loans are just fantastic. They, 0 down, like there's no down payment that's necessary. You can literally buy a $600,000 home and put not a dime down. The payment is probably going to be up there, because you're not putting anything down. But the great thing about it is no down payment, and obviously you still have to have your closing costs, for a VA loan, just like the other loans. And generally, closing costs are going to be between 3 and 4%. The purchase price is kind of like a good number to work off of. It's not exact by any means, but it's usually a good rough estimate. But VA loans, we have the same interest rates generally as FHA, so they're very competitive interest rate wise, so they're lower than conventional, 0 down. And the big piece is that you do not get charged mortgage insurance on a VA loan. Doesn't matter, it's pretty amazing when you think about it. You're basically going into a home that's 0% down, you're only paying the closing costs, and you're also not paying any private mortgage insurance. So on a $300,000, $400,000, $500,000 home, that could be $200 a month that you're saving, off the payment. So that's
huge.
It's huge. It's an amazing, benefit. Plus, the nice thing about VA loans too is they allow for one of the things that we qualify people with is their debt to income ratio. They actually have the highest allowable debt to income ratio. So out of all the loan options that are out there, VA actually gives you kind of the biggest bang for your buck, so to speak, affordability wise, on the home. So it's just a great loan. The only thing with the VA loan is that you're only allowed in most situations that can be your only home. You know what I'm saying? Like if you have a conventional loan, right? You can have a conventional loan on a home that you own, right? And let's say you want to buy another home as an investment. Well, you're fine. You can just use another conventional loan to buy that investment property. But with VA, if you go, you can only use, and in most situations, there are some situations where you can buy two, but it's very rare. But in most situations, VA loans are only for a primary home purchase. And if you already have a VA loan on the home you're living in and you want to buy another one, you generally have to go conventional or FHA. You can't do another VA loan for the other home. It's generally just for, a primary purchase. But they're just amazing. Honestly, right now in this housing market, a lot of listings are offering concessions, seller concessions right now. Inventory is starting to go up. It isn't like it was 2 years ago where, everyone was bidding on homes. And if you're a VA buyer right now, you're putting zero down. And if a great real estate agent like yourself can negotiate a 3 or 4% seller concession, right, from somebody who's selling the home, if I'm a VA buyer, I'm getting into that house, no money.
Yes.
No money, because I don't have to put a down payment. You're basically negotiating my closing costs, right, for the loan.
Correct.
I'm basically getting into a brand new home, and I'm basically paying almost nothing out of my pocket. Really, the only thing that would really be a cost to them would be to pay for the inspections, the appraisal, and even the appraisal actually is part of closing costs, and those can be paid for by the seller. So really, theoretically, in fact, I did a loan this summer for the Hometown Heroes, where someone literally, all they paid for was their inspections. It was like $400, and they actually got a check back at closing for $300. So literally, it was like $100 out of his pocket, and he's in a new home.
I love that.
Yeah, they're amazing.
I recently I was doing an open house, and this person walked in, and he was, he's a veteran, and he was asking me a question. And so he already used the approval, right? He already used the VA loan, right? But his approval was bigger than the house that he purchased.
Yes.
What will be the whole process if somebody wants to sell that home, pay off what they own on that one, and then just get into a new one?
Oh, I mean, with VA, I'm trying to explain this. Yeah, it's kind of difficult, but what happens with VA is that when you're a veteran, you get what's called a certificate of eligibility, okay?
Yeah,
and that COE for short lets the veteran know how much they're eligible for, okay? And then what happens is when they make their first home purchase, they generally don't use all of that, is what it is. And in certain situations, if you have enough eligibility left, you can actually, if the second home that you're trying to buy, if that eligibility is enough to cover it, then actually you can have 2 VA loans at the same time. But in most situations, generally what the VA buyer has to do is sell the first home, buy the second, and it's done instantaneously. Like literally you can close on the first home in the morning and close on the second home in the afternoon.
Okay.
Yeah, and there's no hang up, like, you know what I'm saying? Like the lender will already understand that, hey, that VA benefit that's associated with the first home will automatically, once they close in the morning, that'll get cleared off, and then it'll just, we'll just move it right into the new home. So there's no like time frame, I think is what your question was, like how does that work?
Yeah, the time frame, and also if they could do it, because that the person didn't know if they were eligible to do so.
Right. Well, the only other thing you have to be careful of with VA loans too, and a lot of mistakes get made from lenders on this, and people get into trouble on this, is that, like, let's say you're if you are a veteran and you're using a VA loan, like, and if you're trying to use like 2 people on the loan, okay, has to be husband and wife. Okay, that's where a lot of people get into trouble, okay? If they're trying to do zero down, like a zero down payment, okay? If they're trying to go zero down and they don't have the funds for, for a down payment, because what happens is that there are some lenders out there that don't necessarily know all the rules, and you might get yourself into trouble because, let's say it's a boyfriend-girlfriend situation, or even like a mother-son, father, whatever it might be, whatever combination it might be, trying to buy that home. Just remember, if you're a veteran and you're planning on putting zero down, then the only time you can use 2 people on the loan is if it's husband and wife. Okay, and it's very important to remember, because I've had people come to me trying to fix issues, where they're like, oh, we were told, we were pre-approved for a loan, and it turns out that we found out later that they weren't married, so just remember, that if you are doing more than one person on a loan, for a VA loan, be careful. Just be careful out there, ask questions, of whatever lender you're using. I mean, hopefully they would use us, but there's banks out there, there's credit unions, there's online places, and they don't necessarily know
that's the thing.
all the rules.
The reason why I wanted to do this video is just to really share the knowledge, share the information, because you're just too good, we don't want to burn any bridges. It's just trying to get some transactions that we want to build that relationship for a long time. Right. So it's just good to have people that we can trust, that I know if we, if we get a client or whatnot, you will take care of them, and then you will have the knowledge to actually provide the best product.
The pre-approval is so important. It's a lot of people don't understand that, and you'd be shocked by this, but mortgage loan officers that work in banks they require 0 training, which is fascinating. People don't understand that. I'm not trying to badmouth banks, don't get me wrong. But what I am saying though is that generally, when you're independent like myself, I have to go through, just like you do, you have continuing education, every year. You have to pass a very difficult exam, which I'm sure, I mean, the realtor exam, I'm sure, was probably just as fun as my exam was. You have to pass state exams, you have to pass federal exams, you have to, do continuing education every year. For banks, shockingly enough, they actually don't require that. All you need is just a number that gets issued to you, and you can basically, do loans almost right away. And again, I'm sure there's great loan officers out there for banks, and I'm sure there's also, people who are newer, out there. So it's just something to be careful of, and make sure that your pre-approval is, sometimes people are just so happy to hear it, you know what I mean? They're just so excited, but they don't get a really good, thorough pre-approval done. You really shouldn't, if your lender is not asking you for all of your documents to verify everything, like you should be verifying if you're like, you know, if you're a normal employed individual that's W-2, I mean, they should be asking for your W-2s, they should be asking for your pay stubs, they should be asking for proof of funds, you know, they should be asking for all these things. And if your person you're working with is not asking you for those, and they're just giving you a letter saying you're pre-approved and go find a house, be careful, buyer beware, because you don't want to get into a situation where you're paying $400 for an inspection, you're under contract, you pay $600 for an appraisal, now you're into it for $1,000 there, and you put a deposit down for a couple grand, and then 2 weeks later you're finding out that you don't qualify. So just be careful.
So as far as like, let's say that somebody's out of the state or somewhere, do you have the flexibility to do everything remotely? Or do they need to be in person, or how do you normally handle that process?
Honestly, I probably don't even see
90%.
Yeah, 90%. I mean, I try and go to almost every closing I can if it's in the area, you know, for the closings. But I can do a loan anywhere in the state of Florida. I'm just not licensed outside of Florida right now. Our agency is looking to move. I think Christian mentioned that we're looking to do 2 other states soon, where we can do it in other states if people move and things. But yeah, honestly, the vast majority of people, I just make contact, you know, via phone. Most of it's electronic. My preference is, to be honest, is my favorite transactions are when I get to meet with my new client face-to-face with a realtor like yourself together in a room at first. Because honestly, I think, especially for the first-time home buyer who really has no idea what's going on, being able to sit down at the table and all of us put a plan together. You know, really ask a lot of questions, you know, about like, not just the loan, you know, but really like, what do you want your payment to be? You know, a lot of people, they may get approved, you know, saying for a $400,000 house. But if you're not telling them what the payment's gonna be, you know, just because I'm approved for a $400,000 house, and just because I'm approved for a $3,500 a month payment, there may be no way in their mind that they're thinking, I don't want I don't want that payment. You know what I mean? Like, I want a $2,500 a month payment. You know what I mean? And then as a realtor, you don't want to be wasting your time, you know, and their time, showing them homes and getting them all excited about these homes when it's way out of like what they really want to. So that's why it's so critical, I think, to get together, really discuss like, hey, what do you want your payment to be? You know, because honestly, that's the most important thing, because if you've got a certain max level that you want your monthly payment to be, that's going to determine what you're going to show them. You know, and you want to, you know, you don't, again, it's an expectation thing. You know, you want to be, you know, bringing them to the right homes. They're going to be in their, you know, in the area that they need to be in. But I see that all the time. People are like, you know, I pre-approve them for a certain amount, and then they go out looking, and then, you know, they say, hey, we're really interested in this house, and then I do the workup, I tell them what their payment's going to be, and they're like, oh, we didn't even think about that. You know, and so that's just an important thing to think about too.
No, definitely. I like to sit down and really like tell me everything, like why are you looking to buy, like what's the reason behind it, like what are your expectations, how can we just like make this process very smooth, but also I'm honest and transparent up front, so you know, like that person knows what to expect, you know, like from us, also so they can manage you know, like their self themselves.
Absolutely. I mean, I think it's the best way. Not everybody's comfortable. You know, sometimes people just want to do business, you know, certain ways. But honestly, I just think that if you have the capability of working, you know, with a lender that can meet you personally, you know, a real estate agent that can meet with you personally, you know, coming together as a team and really discussing everything together and putting a plan together, I think honestly, my best transactions are always those transactions, because they're always happy, they always get exactly what they want, and honestly those are always the fastest transactions because there's no confusion. You know, there's no misunderstandings, there's no anything like that. You know, everyone understands exactly like what we're going to be doing and stay focused, and I don't know, they usually end up being the best.
Oh, that's good. Chris, you're awesome. Thank you so much. I look forward to making some more content.
Oh, sure.
And just giving them more information about you. Thank you so much.
Sure, you're welcome.